Hello everyone, Dave Keller here with StockCharts.com. Today on the Final Bar, we're back in our studio in Redmond, Washington. We'll debrief on what happened today in the markets, also set the stage for Fed Week this week. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. Just got back from a week in New York, meeting with a lot of peers, former colleagues, and mentors in the industry at the CMT 50th Anniversary Symposium in New York. It was a lot of fun. I'll share with you some of the insights that we were able to draw from some of the attendees, a lot of the speakers as well. Had an opportunity to interview two of my mentors, Ralph Acampora and Luis Yamada, on a live version of this show on Friday, which you can find on our YouTube channel and at StockChartsTV.com, our on-demand platform. At the end of the day, I had a lot of conversations with a lot of market practitioners, all trying to navigate these markets. We're all, I would say, collectively scratching our heads about all the different pieces of information, all the different narratives that we're trying to understand. At the end of the day, what's really working and what is not working? That's what the technical toolkit is really optimized to help us understand. So we're going to get into our market recap here. We'll see what we can find by looking at the charts together. Check in on what's happening with the S&P and the major averages today, and then we'll dig into some of the charts that I think are worth paying attention to during this very important Fed week. Let's start with the major averages. You'll note a lot of red on this page. It's not heavy red though, and we don't scale this. It's pretty much green positive, red negative. You can see it's all red negative, but not by much, right? These are tiny slivers below zero. So the S&P, the Dow, the NASDAQ, all essentially where they were on Friday's close, to be honest with you, just slightly negative, but not by much. New York Composite, Toronto, all about the same, mid caps, small caps. It's pretty unchanged. Now, this is not unusual, and if you asked me what is the normal sort of expected playbook for the couple days before a big Fed meeting, arguably a pivotal one, because everyone's trying to understand and anticipate the future path of interest rate hikes or interest rate lowering. This is pretty much what I would say. Lighter volume, not a lot of movement. Some individual names, of course, we're in the middle of earnings season, so some stocks are going to move. But at the end of the day, are investors making some big rotational bets? Most likely not. You'll expect that going into Wednesday, certainly at the end of the day Wednesday. We've got some serious earnings happening between now and then, and those, again, could move the market. But end of the day, it's usually a little bit of lighter sort of wait-and-see mode. The VIX, by the way, up a bit, but still really low, right? Down at 16. That's a pretty low level for the VIX. You can see looking at a two-day preview chart. Here's Friday's rally. It's funny, Thursday and Friday when we were at the symposium in New York, again, celebrating 50 years of the CMT Association, markets just sort of drifting higher pretty consistently, which is an interesting backdrop to the discussions we were having about all the challenges really facing risk assets here through the remainder of the year. Let's look at interest rates very quickly, because I think this is an important narrative to follow. One of my conversations, again, with interviewing Luis Yamada on the show on Friday, she was talking a lot about interest rates. Ralph as well, we were talking about that. A number of the conversations I had off of the stage were focused on interest rate and this rotation from a multi-decade uptrend in bond prices, downtrend in rates, that reversed arguably a couple years ago. And what we've seen so far is a rising rate environment. Now, rates have come off a bit, right? 10-year yield was up to about 4.25. We're now around 3.57. So, we got down to around 3.25 not too long ago. We're bouncing up a little bit. But overall, the argument that I heard from a lot of practitioners was this pullback in rates that we've seen is a pullback, right? The larger trend, it's almost undeniable that we're in a rising rate environment. This is the conditions that we're in, and a lot of parallels to where we're at right now versus sort of the 1950s, 1960s, which is where you're in the last time we were in a real rising rate environment. and trying to deal with some of these conditions we're dealing with now. Bond prices, of course, moving lower when interest rates are moving higher, and the dollar index very notably up about 0.5%. Might be something to watch, because when the dollar starts rallying, if and when that would happen, that usually puts a lot of pressure on things like equities and other assets that tend to thrive when the dollar has remained muted. Gold and silver both down just a little bit today, not too much, about 0.5%. Copper prices higher, crude oil prices still lower, and energy was one of the worst performing sectors today in the S&P 500. Just not a lot of upside follow through with the energy space. And again, that's it's interesting how much there was a focus on that sort of a year ago, right? Sort of mid 2022, you saw energy doing very, very well while other areas of the market were struggling. And now you're getting sort of the opposite. The market's sort of rallying, at very least in a short-term rally phase, with energy really struggling to keep pace with the strength you're seeing in other areas of the market. Almost all red on the top 10 cryptocurrencies that we track on our platform. Bitcoin down about 4.5%. Again, these trade over the weekend. So in terms of the absolute levels, Bitcoin's just below 28,000. Ether remaining just above 1,800. Those key round numbers, those big round numbers we talked about, around 30,000 on Bitcoin, 2,000 on Ether. Both of them here in the last month or so have pushed dramatically above those key big round numbers, only to fall back below it. And I would say that lack of follow-through is a really interesting theme, certainly to pay attention to through the course of this week as we get the Fed announcement. We see how risk assets do leading into and more importantly, coming out of those. Cryptocurrencies might be an important place to watch to see if they get a bid and see if they're able to push above those big round numbers. So far, not really being able to do so. And this after yesterday, touching just barely 30,000 before coming into the equity trading day here today. Let's look at a couple different charts. And before I get to the charts, I will share with you two pictures. And I'll do this. I have a lot of pictures. This isn't Dave's picture show, but I did want to share two really cool moments. And again, I'll share some of the insights that I picked up as much as I can within the course of a 30-minute show every day. But I was able to share the stage with Luis Yamada and Ralph Ikampora. Again, if you missed that, go to our YouTube channel. We posted that for everyone to view. The CMT Association, really, we appreciate them allowing us to broadcast that live to our StockCharts TV audience. You can find it there and at StockChartsTV.com. I'd mentioned the comments about interest rates, which I think are absolutely true. This is some of the guys from All-Star Charts. You'll see Andrew Thrasher from Thrasher Analytics, Jay Woods, longtime executive floor governor. We had a lot of fun on the floor of the New York Stock Exchange. This was Thursday evening, and we could not pass an opportunity to get a picture below the First Republic Bank logo, thinking, boy, maybe this is the last time we see it in public. Of course, a lot has happened there between Thursday evening and today in terms of a lot of choppiness and uncertainty with those bank stocks. So having said that, let's look at some of the charts that we discussed as a group, and I know you're certainly looking at as well. You know, with a lot of individual equities and ETFs, and certainly with the major averages, it's all about, as we've described on this show, can we trade not just to resistance, but through resistance? For the S&P 500, I think 4,100 was the level we first keyed in on in the fourth quarter, when we rallied up to a trend line and stalled out at 4,100. We finally broke above there in February, only to pull back below soon after. What's happened in the last month, look at how we've traded around that 4,100 level. We broke above there again in late March. We pulled back here in mid-April, and now finishing the month of April, rotating back to the upside, up to 4,200. You know, I think the all-clear signal, if there is one of those, has to certainly start with the S&P getting above 4,200. What's interesting is today on the SPX, you have what's called a shooting star candle. It's actually a short-term negative signal for what it's worth. Tells you about the next 1 to 3 bars, more likely lower than higher. That would be negated if the S&P would get above 4,200. So that big, thick green line we've had on our chart remains a very important level. If we can get above there, you know, super encouraging. The challenge I would have, and I had dinner with a number of the attendees, some analysts that I followed for years, some that I used to work with in Boston, and I would say the description we had about the markets as a group, if I could summarize, was the sloppy chop phase, right? This is sort of a choppy, unknown phase. I had, we talked to the group, the subset of the attendees that were bullish, were sort of thinking we get above 4,200, but no one was willing to say we get much above 4,300, right? It's sort of like bullish, meaning we might go up a little bit. The bears, and I guess I would describe myself as more in that bucket, thought more about a retest of the lows here, retest of 3,800. But did any of us think we'd go dramatically below there? Not really. And any of us that did thought that would be a fantastic buying opportunity, most likely, right? Because you'd be at the lower end of the range. So again, we kept coming back as a group to the fact that, or the reality that we're all sort of still in this consolidation phase. For every bullish configuration, there's a bearish configuration. It seems like out there somewhere. And at the end of the day, the market is netting out to sort of an unchanged, choppy environment. What that means is you're not getting a lot of benefit from broad exposure to equities. You need to focus on some of the areas of strength and areas of opportunity. Now, if the markets aren't really doing particularly well, can we go to other asset classes, right? Something like bonds or cryptocurrencies. Maybe, but probably not so much. And I will tell you, the chart of the TLT, this is looking at the last 3 years, just to show, again, when we talk about a rising rate environment, it's not talking about this bounce in the TLT. And again, this is sort of like the 10-year yield inverted, right? Because this is bond prices. So if bonds have rallied off of the October lows, just like equities did, interest rates have come down, right? And this is where the, here in the fourth quarter is where the 10-year yield got up to around 425 and then pulled back, closer to where it is now. But if you look, the TLT starting in December has had a number of attempts to get above the 108 level, $108. This is for a long bond ETF. It's been unable to do that. And today, for example, we're once again blowing back below the two moving averages that we're showing on this page, the 50 and 200-day moving averages. So you're getting a lack of follow through in the bond markets. You can see that the momentum is sort of sideways. Again, sort of that choppy slop sort of configuration. So does it benefit you to go out of equities and go into something like bonds as an opportunity? Not really, right? And what you're seeing from the prices is that both of them are essentially sideways. We're still sort of in this wait and see mode. With Bitcoin and with Ethereum, I think it's an interesting configuration we're seeing right now. Both of them have put in a bit of a lower high. So you can see that Bitcoin topped out here again around 30,000. I would consider that sort of mid-April move as an attempt to get above 30,000. It didn't really hold. We pulled back to an ascending 50-day moving average. We tested it again, pulled back again, and once again, we're at an ascending 50-day moving average. The last time we broke that, we got all the way down to the 200-day moving average. That would be just below 22,000 if we would push back though over the next 3 or 4 weeks. So Bitcoin sort of in that pullback mode. Does it hold that level? And I think that's where you need to start thinking about at what's your line in the sand, right? Is it a break below the 50-day? Is it a new low below 27,000? What would convince you that this uptrend phase we've been in over the last 5 or 6 months is now starting to stall out a little bit? So what is working out there? Let's look at a couple charts that are actually moving higher. You got to think about sort of things like semiconductors, NVIDIA making a new high for the year today, up another 4%. So again, while there's been this choppy environment, there are areas like NVIDIA doing just fine. LVS is an earnings name this week, gapping higher, making a new 52-week high again today. So there are areas of the market showing strength. You know where we're not necessarily seeing strength or at least follow through? JP Morgan. I showed the picture of us on the floor of the exchange in front of the First Republic logo. JP Morgan, of course, intimately involved in this sort of bailout, or wherever we're describing the interaction with First Republic over the weekend. Today, gapping higher a little bit, about 2%, but failing to get above resistance. Again, sort of what I think characterizes a market like this is stocks trading up to resistance, but not through resistance. That's my concern on a chart like JPM. Folks, let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. A couple quick announcements before we get to the Final Bar mailbag. First off, we welcome your questions. The mailbag is fueled by people like you sending in questions via email that we can review and answer along with the course of our normal show. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Just put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to hear from you. Can't wait to do it, and we'll look forward to answering your question in our next mailbag end of this week on Friday's show. Also want to let you know about the upcoming schedule. Tomorrow, we have Julius DeKempener of RRG Research joining us live in the studio. And I should mention, all three of our guests this week are live in the studio, which is pretty awesome. We have Julius tomorrow. Mish Schneider of Market Gauge will be coming up tomorrow. T.G. Watkins of Simpler Trading here in the Seattle area will be joining us live in the studio on Thursday. By the way, we will also be recording our market outlook called Charting Forward. This will be our second edition. We did one earlier this year. We'll do another one coming up at the end of this week. We'll record it, I think, on Thursday in the studio here. We'll be broadcasting it for you next Monday at 11 a.m., so don't miss that one. Let us get to the Final Bar mailbag. As a reminder, keep the questions coming to the Final Bar at StockCharts.com. Let's get to question number one. Dave, on the StockCharts platform, when should I use SharpCharts versus ACP? And I love it. The fact that you understand that we have the two different parts of our platform and that you're thinking about how to use them is fantastic. And I really appreciate that thought. To be honest with you, I use both of them. On this show, I tend to feature SharpCharts more often. And what I found is people that have used the StockCharts platform for quite some time, you might have a great setup inside the normal StockCharts sort of environment, right? So I tend to use the dashboard very heavily. I have a bunch of chart lists that I use, and I really enjoy sort of going through them. But what you'll notice is over time, we're incorporating ACP more into different parts of the platforms. This is my main dashboard. I can actually go right to my ACP chart list and start to break them down. Of course, the easiest way to get to ACP is at the top of the dashboard. That's the way to get over to it. I actually use both of them as well. Here's what we're generally thinking at this point, as the two platforms are separate. And this is the way I would think of it, to be honest with you. The SharpCharts platform, sort of this traditional platform, has often been, and I think from my experience in the industry about 23 years, has always been one of the cleanest, most beautiful charts to share, put in a presentation, to share with your friends, to post on social media. The charts just look clean. And the reason why they do it is because they're all based on images. Every time you tweak this chart, it's creating a new pristine PNG or JPEG file, whatever you need, that it's very easy to share, to send, to post on Twitter or LinkedIn or something like that. And that's where I tend to use it. And that's why I've used it often to put in reports, share with clients, and put on social media. But if I'm trying to follow the markets dynamically, if I have a trading system that is based on, moment-to-moment movements, if I'm trying to analyze stocks and ETFs real time during the day and do more dynamic analysis and visualization, ACP is a much more robust platform for that. We also have all of the plugin environment, things like Mark Chaikin's indicator, the StockCharts free advanced indicator pack, which includes things like percent from a moving average. Larry Williams, many others actually have plugins. The go, no go charts, for example, are another ones. So I found ACP, it's just a much more flexible platform that allows us to do a lot of really cool things with different visualizations and try things. Over time, I think you will find both of these kind of more and more closely related. And we have SharpCharts 3.0, our brand new version of it coming out later this year. So at this point, I usually have tabs open on my own laptop back in my office with both of these, and I tend to go back and forth between them depending on what questions I'm going to answer. I love how ACP allows me to have multiple charts looking at different time frames, looking at different things at the same time. I love how clean and pristine and beautiful the SharpCharts platforms looks when I want to share it around. So I would encourage you to explore both and also watch a lot of the shows on StockCharts TV, because you will find people like Joe Rabel and Alex Cole using ACP. You will find people like Tom Boley and Greg Schnell using SharpCharts, and you as a paid member have access to all of that. So enjoy. Next question. Based on Sam Stovall's sector rotation model, when should we invest in REITs? And you actually shared some really good thoughts within your question. And you should know when you guys send in questions, I have to summarize them a little bit for the visual and try to get to the essence of your question. But I appreciate you sharing more detail. I think you're talking about on our sector perf chart, our performance chart, which shows you the performance in different sectors. You can bring different time frames in at the lower right there. If you scroll down a little bit, you'll see Sam Stovall's sector rotation model. Now, Sam is at CFRA Research in New York. He's a longtime friend of StockCharts, and I met him through a mentor of mine and friend of his, Ralph Acampora, years ago, where I started talking with him. He really, literally has written the book on sector rotation. This is a simple visualization that I've referred to so often in my career to just think about the traditional relationship between the stock market cycle, which is in orange, the economic cycle, which is in blue, and the things that tend to lead and tend to lag at different parts in the cycle. Now, I have to tell you, does it always 100% follow this playbook? Of course not, right? Something's always different. Unusual things happen. That is why it's just not super easy to manage money or to have good returns, because it's challenging. And sometimes things might be a little bit different, and the conditions might evolve real time. However, I've been amazed at how closely this helps you focus, or how well this helps you focus on the areas of expectation we most likely are in. So how would we describe the conditions right now? Well, I would argue the market has come off quite a bit, right? And we've seen this condition where staples, utilities, healthcare certainly have started to do very well. Once the stock market starts to get to the end of a decline and starts to rotate higher, toward the end of the decline, that's when you tend to see real estate do better. And you asked about REITs, that's the real estate sector, or the XLRE would be the ETF to track if you want to get a sense of that. There are REIT indexes as well, but I think XLRE or IYR are two pretty liquid ETFs to follow the REIT space. REITs are actually pretty diverse. They cover a lot of different things like malls and office space and residential spaces as well. But in the end, the XLRE is a pretty good way to track it. What I would say is most interesting to look for is when technology, discretionary communication services, look at when they tend to work. It's usually at the beginning of the big recovery. And now the economic data is actually remains negative during that period, right? The early leadership is usually away from defensives into things like growth sectors. The market tends to do better. The economic data is where it's really starting to struggle. That's why it's kind of unclear as to where we're at right now, because I would argue we're sort of in this phase somewhere, but depending on what you look at, you might be getting some different information. By the way, interest rates tend to peak right about at this point here when real estates are doing well. Has the 10-year peaked at 425? I don't know, and others don't know as well. And that's why, again, this is an important visualization to watch. Keep an eye on this one, by the way. To get to this, if you missed it, go to Charts and Tools in the upper left corner of our website. Scroll down that right side, and you'll get to this thing that says Sector Performance Chart. And then scroll down below that visualization. You'll get the information I was just sharing with you. Beautifully done by Sam Stovall. Next question. Should one always plot indicators such as RSI or PPO? Here we go. Of the stock symbol alone, or are there any situations where technical indicators on a ratio chart can be useful? Let me bring in, you actually had a couple charts that you shared with you that I'm showing on the screen here. You showed this chart of Pepsi, which talk about stocks actually managing to make new highs in a challenging environment. Beverages are one area of the market where you're certainly seeing that. So this is your chart of Pepsi that you sent me. Looks like relative strength at the top. So this is Pepsi versus the S&P, but the main chart is a candle chart of PEP, the stock. We have some Bollinger Bands. By the way, I saw Joan Bollinger at the event, among many who sort of ran out of, I jotted down so many people that I ran into that I'll follow up with soon, and then some indicators below there. So you're running these indicators on the chart of Pepsi. Now, your next one is doing the same chart, but you're actually running it on the ratio, right? So the main candle chart is showing you Pepsi versus the consumer staples sector, and then you're doing some analysis on that. And your question was, should I run indicators on that ratio? I love your question. So my point number one is absolutely. Point number two is, but be very clear on what you're looking at. And here's what happens, right? When you run that same template, but you actually run it on the ratio, look at what happens here. This top chart, this top panel, is a relative strength of whatever you type in that ticker box versus the S&P 500. So if you type a ratio, you're actually doing the ratio of this ratio to another thing. And I will tell you what that means is this is basically a fairly meaningless data series, and I would not look at this and draw any conclusion. And this is what happens. You start drawing ratios and then doing ratios of other ratios. You start seeing things moving, and I've had people say, all right, so this means X, Y, Z, and I have to tell them, actually, nope, you're kind of looking at like a second derivative of what that is. Just forget that and get rid of it. So I would make sure you always look at the tickers of exactly what each data series represents. A candle chart of this I don't think makes a ton of sense. Just doing it on a closing basis is probably plenty of information, and volume is meaningless in that, so you can probably take that off as well. The indicators, what it's going to tell you is strength or weakness, underlying strength or weakness in the relative performance of Pepsi versus the consumer staples sector. As long as you understand that that's what you're thinking about, I think that's fantastic. And just so you know, if you've ever used the RRG, which I've used for many, many years, and if you find it helpful, which I absolutely do, this is the basic building blocks of what the RRG is doing. It's using relative strength and running indicators on relative strength to create that visualization. So you're going down the right path of the expertise that Julius de Kempener used to create the RRG many, many moons ago. Next question. Is it time to buy the dips in the US dollar with a 3-month time horizon? I appreciate the straightforward nature of your question. I have to start with our standard disclaimer. I am certainly not recommending that you do anything, so make sure this is you recognize this for educational purposes only. However, we're looking at the US dollar over the last 2 years. We are talking about, is it time to buy the dips? I think the challenge for the US dollar is it's not going up yet, right? And so buying the dips, the first way that you can validate that that may be a good idea is you have to be going up, right? Buying the dips works if the trend is up, which means in 2022, it certainly made sense to buy the dips because the trend overall was up, right? Higher highs, higher lows, upward sloping moving averages, the prices above both of those. We kept pulling back to an ascending 50-day moving average. Look how clear and clean a lot of these pullbacks were. It almost looks easy at this point. It wasn't at the time, right? It's kind of confusing for sure. But looking back, 2022 for the dollar was just this nice, consistent, orderly uptrend. Now, of course, this is happening as risk assets were absolutely cratering during that particular trend. So the reason why I would have to say I don't see this as an environment where buy the dips is necessarily going to be an ideal strategy is because we're not going up yet. We're still kind of going down. Buy the dips is something you think about in an uptrend. So step one, the US dollar needs to get in an uptrend. So that takes us to the next question, which is how do we know when the US dollar is going in an uptrend? Number one, it has to stop going down. It's maybe done that, right? And I think the dollar is testing support. And I think if you think of it that way, is it time to buy the weakness in the dollar? I could see the argument for that because a lot of indicators are going to start to turn higher. You see the RSI is actually making a higher low. If I switch that bottom one to something like PPO, this is more of a trend following technique, trying to identify when we're rotating higher. You can see that the PPO is actually giving a buy signal here about 2 weeks ago, suggesting that the dollar most likely bottoming out at support. What you have to be careful of is if you're buying weakness on a chart, two things. Number one, recognize the entry point, but number two, recognize your exit strategy, right? What would happen that would tell you that that buy signal was not appropriate? And I think for the chart of the dollar, as with anything, if you're buying weakness, you have to make sure that you minimize the downside, because a lot of times you can buy a falling knife, it keeps going lower, and all of a sudden you get in a really bad situation. So think about that as you're looking at the chart of the US dollar. I would say this current level has to hold for sure, and I'd love to see a little more movement to the upside to even think about the idea of buying on dips on any time frame. Folks, we need to wrap our show. It goes by so quickly, but let's get to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1, the New York Composite Index. The opening panel at the CMT Symposium on Wednesday night of last week featured Craig Johnson of Piper Sandler, John Kolovis, who is one of my analysts at Fidelity now, having a great career on the sell side, and Mark Newton of Fundstrat, moderated by Bob Pisani of CNBC. It was a really good discussion. They focused a lot on equal weighted indexes and the fact that if you take the mega cap sort of FANG trade out of the way, a lot of stocks are actually not doing particularly well. You know, one of the charts that I have in my normal daily routine is the New York Composite Index, which on our platform is $NYA. Now, the NYSE Composite Index, little different configuration. It's bigger than the S&P. It has more stocks, about 2,000 some stocks. So it's a much broader universe, and it gets into some of the smaller names, but of course not NASDAQ names, right? Those wouldn't, of course, be included on here. So what's interesting about the New York Composite Index is that it's made a low around 14,500 here in March. It actually undercut the December low, which was a little above there, around 14,900. From there, though, look at how long that the NYSE Composite Index has been below this green shaded area. This is right around 15,800 to 16,000. The last time we really pushed above there was in late January, early February. We failed and pulled right back down. Once again, are we rallying off the March low? Yeah. But are we getting above 16,000? If and when we do that, that's when you will hear me start to be a lot more encouraged about upside potential for stocks. The fact that this main benchmark on the NYSE cannot do it causes me to be a little more tentative about upside potential. Chart number 2, by the way, if stocks are not quite following through, do we do the normal sort of 60-40 kind of thinking and go over to the bond markets and gain some benefit from diversifying into that asset class? I have a real problem with diversifying into asset classes that are not doing particularly well. And just like we mentioned earlier, the TLT is not breaking out. It's actually pulling back from resistance while the S&P is pushing higher. So even with all this uncertainty in stocks, even with all the concerns about what's happening, even though you can get a decent interest rate in the CD, so why do you need income stocks? Look at the relative strength of stocks versus bonds through 2020, through 2021, 2022, and now 2023. It just overall keeps trending higher. It's been above its 200-day moving average since the middle of 2020, not too long after the 2020 low. So as long as that remains in place, it's telling you bonds are just not a great value proposition versus the stability, even in a pullback phase, that you can get from equities in the form of the S&P 500. Final chart. I like to finish the show on a high note as much as I can. I did a quick scan on stocks that were able to break out when I looked at the mid-cap scooter rankings. This is one of the top 10 names. The ticker is HIMS, H-I-M-S. The name of the company is Hims and Hers Health. I don't know a lot about the stock. I do know it's a mid-cap company, about a $2.5 billion market cap. They do telehealth. It's based in the West Coast, I think, in California. What I love, none of that is important. What is important is the fact that the price is going up and it's above an upward sloping 50 and 200-day moving average. Feel confident, feel good when your portfolio looks like that in an uptrend. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well. Have a good night. See you tomorrow.